Module 4, the stock market indexes. Here's a quick explanation of how the stock market indexes work. Alright, so everything under the phrase the stock market makes up the phrase the stock market. So the stock exchanges are the ones who hold all of the data for companies to be traded all over the world. The two stock exchanges in the United States are the New York Stock Exchange and the NASDAQ. The New York Stock Exchange is an actual place that you can go to located on Wall Street in Manhattan, New York. The NASDAQ is the first digital-only stock exchange. It has no location. Both of these exchanges serve different purposes, as the New York Stock Exchange only holds companies that have met strict rules and regulations, and they must fall in one of the 11 stock market sectors. The NASDAQ, of course, meets those same rules and regulations, but they only hold the biggest and best technology companies. So now we have the indexes. Indexes are essentially just a list of companies that fall under a certain benchmark. Each index has its own criteria for a company to be entered into it. Again, the big three indexes in the United States are the Dow Jones, the S&P 500, and the NASDAQ 100. The Dow Jones is an index of 30 stocks that tracks nothing but companies who impact the economy the most. The S&P 500 holds the 500 largest and most profitable companies in the United States, regardless of what sector they're in. The NASDAQ 100 index holds the top 100 companies in the NASDAQ Stock Exchange. I want you to note that the NASDAQ index is different from the NASDAQ Stock Exchange. The NASDAQ 100 is an index that pulls 100 companies from this right here. One is an exchange, one is a benchmark. And again, within the indexes are stocks. You can look up the stocks within these indexes by just asking Google, what are the stocks within the S&P 500? What are the stocks within the NASDAQ? What are the stocks within the Dow Jones? So remember, the indexes in the stock market are here to categorize and keep track of stocks. The indexes were created by either entrepreneurs or investment firms who wanted to keep track of three things. Number one, the growth of the technology sector, the NASDAQ 100. Two, the growth of the industrial sector, the Dow Jones. And three, the growth of the overall U.S. economy. All right, so what is the S&P 500? Now, because we already talked a lot about the S&P 500 before, I'm not going to keep repeating myself, but I will point out this right here, and we can look over some interesting facts. But in 1923, a company called Standard & Poor's introduced a series of indexes that tracked the largest companies in the United States. In 1957, Standard & Poor's created the S&P 500, which is an index that tracks the performance of the 500 largest United States companies. And we know by now, to invest in an index, you must buy an index fund or an ETF that tracks the performance of it. I do want to say those that beat this index are looked at as geniuses, and the S&P 500 is what the majority of investors compare their returns to. So if y'all want to even look at my returns to make sure I'm not just talking over here, you can look at my performance and you can look at my 1 year cumulative pre-tax return, 61%. The S&P 500 in that same 1 year time frame is 23%. The Dow Jones in that same 1 year time frame is 23%. So I'm absolutely smacking the indexes. So I know exactly what I'm talking about. Let's look at some of these interesting facts though. I want y'all to know the S&P 500 has recovered from every crash that ever existed. I'll talk more about that in a couple slides. Institutions have trouble beating it, and the average return over its entire life is 9.3% per year. This is the investment that we're either going to beat or at least track the performance of. We're not doing anything less than the S&P 500. All right, so much like a stock has a stock price or a share price, indexes have an index price or a share price also. The price of each index is based off of the stocks within the index. For example, the SPY holds 500 companies that each have their own stock price. The institutions then run a bunch of calculations to come up with one solid number that defines the importance of the index. These right here are the ticker symbols of the main ETFs that track the popular three big indexes. These are the prices of each respective index for the ETF versions. At 9:30 a.m., these prices will begin to change as people begin buying and selling shares of these companies. The stock market opens at 9:30 a.m. Monday through Friday and closes at 4 p.m. As people buy and sell these companies throughout the day, the price of the ETF changes too, in accordance with the weightings. Weightings operate like this. All stocks within an index make up 100% of the index. For every dollar you put in, there's a corresponding dollar amount that will go into buying those companies. If you put $100 in SPY, $7.77 will go to Nvidia, $6.76 will go to Microsoft, $5.93 will go to Apple, and so on. This helps you so you don't have to buy 500 different companies at one time, which saves you a whole bunch of time. Here's how to buy the S&P 500. All right, so just to break it down, you have the name of the index, the S&P 500, the index ticker symbol, which is INX or SPX. You have the price of the S&P 500. This is the price of the actual index. Here's the ticker symbol of an index fund that tracks the S&P 500. Vanguard's 500 Index Fund, VFIAX. Then you have an ETF that tracks the S&P 500, ticker symbol SPY. So you are not paying $6,000 to own one share of SPY. What you will pay is $601 for one share if you want to own the ETF, or $570 if you want to contribute to the index fund. The dollar signs mean that you can buy it. There's also something called fractional shares where you don't even have to have this much. You can put in $5 if you wanted to. All right, so again, because we talked about these indexes earlier, I'm not going to get into it a lot, but I will read this. So in 1971, the NASDAQ was founded by a company called the Financial Industry Regulatory Authority. It was the world's first electronic stock exchange. Its main index is the NASDAQ Composite, which is one of the big three indexes. Its main focus is technology stocks. Some interesting facts is that it's the most volatile of the big three indexes. It has the highest rate of return for the big three indexes, and it focuses on adding high growth companies. All right, so because it's only 100 companies in this index and not 500 like the S&P 500, the weightings for the exact same company that's in the S&P 500 may be different in the NASDAQ 100. For example, NVIDIA makes up about 14% of the NASDAQ 100. Compare that to 7% in the S&P 500. The top 5 tech companies make up almost 50% of the entire index. Another thing, some companies are so good they could be in all 3 big stock market indexes. Apple, Microsoft, and NVIDIA are in all 3 indexes. The main focus of the NASDAQ 100 is innovation and growth. Each index has a different goal and purpose. The stocks inside then try to match that goal, and if a company's stocks performing good, they'll get kicked out and replaced by a better company, therefore reconstructing and keeping the fund's value intact. Here's how to buy the NASDAQ 100. Again, you have the name of the index, the NASDAQ Composite, the index ticker, IXIC. You have the ticker symbol of the ETF that tracks the NASDAQ 100, which the most popular one is QQQ by Invesco. And then you have an index fund that tracks it, FNCMX with Fidelity. So again, if you were to open up your investing app and search IXIC, you will not be able to buy it. You have to buy the index fund or ETF that tracks it. All right, so what is the Dow Jones? In 1896, a company called Dow Jones & Company, named after Charles Dow and Edward Jones, launched an index that tracked the largest companies that track the U.S. economy. It's the most mentioned index in the world and holds 30 of the largest industrial companies like Home Depot, Caterpillar, and Boeing. The Dow Jones is the benchmark that tracks the progress of the most important companies that make up the USA. Now, they don't have to be industrial companies or come from the industrial sector, but most of them are. This is the Legacy Index. It's the oldest and it's the first index in the world. These are the top companies that make up or contribute to the GDP or economy the most. Some interesting facts are that it's the highest priced index out of the big three. It has the least return percentage out of the big three relative to inception date because, of course, that was the first, so the numbers would be kind of skewed. All right, so remember, the Dow Jones is a price-weighted index, so the share price of the companies within the index dictate the weightings of the index. A stock price that is higher will make the index move more, affecting the price of the index a lot more. A stock price that is lower will make the index move less, affecting the price of the index a lot less. That is the ticker symbol of one of the popular ETF versions of the Dow Jones. Here's how to buy the Dow Jones. So again, you have the name of the index, the Dow Jones Industrial Average. You have the ticker symbol of the index, DJI. You have the ETF version of the index, which is DIA. And I couldn't really find an index fund that tracks the DIA. So just use the ETF version if you want to buy it. All right, so just one more time for people who have not been paying attention. You do not buy the price of the index. You put money into the index fund or ETF that tracks the index, and your money will mimic the performance of the index. You can use fractional shares. You do not need $44,000 to invest in a Dow. You just buy the ETF version of however much you want to. You can literally put $5 if you wanted to. Do not make this hard. All right, so understand this. If an index doubles, your money doubles. If the price of a stock doubles, your money also doubles. But it would take more effort for the price of an index to double than the price of a stock to double. since there is more stocks and more diversification within an index than just one stock. For example, from the lowest point in 2022 on Meta stock price until now is a return of about 760%. It went from $90 to around $700. That's a return of almost 800%. But the S&P 500 since then has only returned 60%. From 3,700 to about 6,000. That's about 60%. But another thing, Meta dropped over 60% in 2022. From right there to right there is about a 60% drop. While SPY in that same time period only dropped about 30%. From right there to about right there. That's only about 30%. So indexes have long, slow, agonizing drops over an extended period of time. Stocks, however, can have a major drop in one day, and that could be on your average trading day. If one stock inside an index crashes, the index can still give you a good return. But if an index crashes, the stocks inside have all been affected. Indexes are safer, and it takes much more of a market downturn to take an index down, where a stock can go down off of anything. So here's a 20-year annualized return by asset class from 2002 to 2021. So here's what you've been doing for your whole life. You've been investing in cash. So your bank account is cash. Here's inflation. Inflation is outpacing the value of your cash at a rate of almost 100%, meaning every calendar year you are paying double for your necessities. You've been saving all your life and you barely got raises, while inflation is getting higher every year. Now here's the average investor. This is also you. This is the return of the S&P 500. So this is what happens when you try to pick stocks by yourself, and this is the return you get when you invest in an already established index. The average investor sucks compared to the S&P 500. Even if you put your money in commodities like gold, copper, silver, it'll still be better than you holding cash in your little Chime savings account. Definitely better than saving your money on Cash App. Now, if you still want to put most of your money in a savings account, that's on you. I'm just going to call you stupid, because if after looking at this graph, you keep all your cash in a savings account, I'm sorry for you. You are cooked. All right, so the stock market was designed to go up over the long term, even with unforeseen and foreseen events happening along the way that causes volatility. The average annual return of the S&P 500 index for the period shown below was 10.88%. This is 52 years worth of data right here. So as you can see, this is all the little things that the country has went through in the last 52 years. So as you can see, a whole bunch of wars are going on right here. This is the Black Monday stock market crash in 1987. Black Monday happened on October 19, 1987, where the Dow Jones Industrial Average experienced a 22.6% drop in just one day. It is the largest one-day drop in history, and we still recover from that. America goes to war in the Middle East. We recover from that. Oklahoma City bombing. Recover from that. The bull market ends. Tech bubble starts to deflate. This is where the NASDAQ dropped almost 80%, and we still recover from that. 9/11 terrorist attack happened in New York. Recover from that. U.S. invades Iraq. Recover from that. 2009 stock market crash and Great Recession, where the Lehman Brothers filed for bankruptcy. We recover from that. Boston Marathon bombing. Ukraine war. COVID-19 and Russia invades Ukraine. The stock market is sitting at all-time highs right now. So as you can see, it literally does not matter what goes on. The stock market continues to go up because that is what it was designed to do. All right, so here's a hypothetical growth of $1 invested into the S&P 500 from 1926 until 2022. So as you can see, it doesn't matter who's president, the stock market will continue to go up over time. So this is a safe but volatile asset. This is not a risky asset. It is a clear difference between volatility and risk. Volatility refers to the degree of price fluctuations in an asset, while risk is the potential for an investment to lose value. Volatility is a measure of how much a stock's price can swing in either direction. Risk is a chance of experiencing a loss from that price movement. As you can see, as long as you hold, there is no point in stock market history where you lose money over a 20-year period. And if you ever invest while the market is down, you make even more. According to historical data, the S&P 500 has been positive approximately 73% of the time when looking at calendar year returns, meaning that over a long period of time, the market has seen positive returns in roughly 73% of years. I'm going to take that bet every single time. If you told me that I'm going to win a bet 73% of the time, I'm going to take it. This is not even option trading, swing trading, day trading, futures, etc. This is buying and holding the country that you live in. I'm personally going to buy this until the day I die. Remember, the stock market was designed to go up over the long term, even with unforeseen and foreseen events happening along the way that causes volatility. Can you guess what day this was? This was the coronavirus, February 28th, 2020. As you can see, over 99% of stocks were down. This is what's called a heat map of the S&P 500, and it's just basically a preview or snapshot of how the entire index is doing. Look at some of these large cap tech companies. Amazon down 12%, Apple down almost 15%, Microsoft down 14% in one day. Stock market crashes are some of the best opportunities to build wealth over a long period of time. You do not get 14% drops in large cap tech companies unless something is going on in the economy. Use these as buying opportunities sent from God. You will change you and your family's life forever if you just invest while the stock market is crashing. Why can't people beat the S&P 500? I want to start out by saying people lose money in the S&P 500 by foolishly selling their shares whenever the market experiences turbulence. People cannot beat the S&P 500 because they are emotional. They don't have faith in nor have historical knowledge about the market, and they do not have long enough time horizons to let the S&P 500 work for them. The S&P has historically been a bet on the United States. It will only include 500 companies that meet a certain profitability. Because the criteria is so stiff, in order for you to even get in the S&P 500, it will only include the best of the best. And if you're a business and you start slacking up, it has no problem kicking you out. Let me throw something at y'all here. So in 2008, Warren Buffett issued a challenge to the hedge fund industry, which in his view charged exorbitant fees that the fund's performance couldn't justify. Protege Partners LLC accepted, and the two parties placed a $1 million bet. The bet was essentially that an S&P 500 index fund could outperform a hand-picked portfolio of hedge funds over a 10-year period. The bet put two basic investment philosophies against each other: passive and active investing. Buffett has since won this bet, the fund conceding defeat ahead of the contest schedule wrap-up on December 31st, 2017. They wrote, "For all intents and purposes, the game is over. We lost." Warren Buffett's net worth as of 2025 is $147.5 billion. I would 100% listen to what he has to say. If you ain't got to listen to me, you don't have to. Listen to him. Warren Buffett once told LeBron James, "Just making monthly investments in a low-cost index fund makes a lot of sense. Owning a piece of America bought over time, held for 30 to 40 years, is bound to do well." The S&P 500 return since then is actually closer to almost 150%. Again, do not listen to me, listen to him. People cannot beat the S&P 500 due to its rebalance and filtration system. It puts only the best companies in there and it kicks out the rest. It caps off at 500 companies, perfectly crafted with only the best companies. Therefore, it is poised to go up over time, and it will drop in large amounts only and only if something is going on in the economy. To be included in the S&P 500, a company must meet the following requirements. Market cap. They have a minimum market capitalization of a specified amount, currently around $20.5 billion. They must be a company based in the United States. They have to be listed on major stock exchanges like the NYSE or the NASDAQ. They have to have positive earnings. These earnings need to be positive in the most recent quarter and over the previous 4 quarters, which just means over the previous year. There are 4 quarters in every year. Liquidity. They must have sufficient trading volume with a minimum number of shares traded each month, and the public float. A significant portion of the company's shares must be available for public trading. Some key points to remember: the S&P 500 Index Committee determines which companies are eligible for inclusion based on these criteria. The exact market capitalization threshold can change periodically. Companies must also meet specific requirements regarding their corporate structure and stock type. So I get the question all the time: will the S&P 500 ever go to zero? Will I lose 100% of my money? If the S&P 500 went to zero, we have a more serious problem, and at that point, we are no longer even a country. If the top 500 companies just disappeared, life would not be as we know it is right now. Here is what I mean when I say the indexes kick out companies. So here's an article. SMCI's shocking NASDAQ 100 exit. SMCI, the San Jose-based software company, and its investors have been on a roller coaster ride in 2024. After a 60% drop in market value over the past 6 months, SMCI was removed from the NASDAQ 100, making way for Palantir Technologies. This reconstruction is part of the annual update of the NASDAQ 100 index, aimed at ensuring that the index index accurately represents the largest non-financial companies listed on the NASDAQ stock exchange. So as you can see, Palantir stock shot up right when they told everybody that Palantir would be added to the S&P 500. SMCI stock has failed ever since they were told that they would be kicked out. It is an extremely bad sign if you're an investor of a company that gets kicked out of an index. I'm not going to tell you to sell, but just make sure you keep watching their earning reports and make sure you are reading the 10K and listening to the earnings call so you can see why that stock is dropping. Here's an explanation of the stock market sectors. There are 11 sectors in the stock market. A good way to be diversified is to pick the top performing companies within the top performing sectors. At number 1, we have information technology. Think AI, semiconductors, innovation. 2 companies for that is NVIDIA and Microsoft. Number 2, healthcare. Think medical devices, health insurance companies, etc. Companies for those are Eli Lilly, Humana, and United Health Group. 3, consumer discretionary. Think expendables, things we do not need outside of hygiene products or products we need to live. Think Home Depot and Amazon. 4, consumer staples. Think the essentials, toilet paper, Pampers, Tylenol, Listerine. 2 companies for that is Procter & Gamble and Johnson & Johnson. 5, communication services. Think cell phone services and cell phone tower companies. Think AT&T, T-Mobile, Verizon. 6, utilities. Electric, gas, and water companies. Think the Southern Company or American Water. The Southern Company is the people that run Georgia Power. 7, industrials. Think machinery, tools, industrial products, aerospace and defense firms, transportation and logistics services. Think Caterpillar, UPS, Old Dominion. 8, materials. Think development and processing of raw materials, fertilizers, farming. Think Sherwin-Williams, the paint company, and Vulcan Metals. 9, financials. Think banks or investment firms. These are your JP Morgans, Wells Fargo's, Citigroups, Morgan Stanley. 10, energy. These are your natural gas, petroleum, coal, renewable sources companies. Think Chevron, ExxonMobil, Duke Energy Company. And 11, real estate. These are going to be your REITs, your real estate investment trusts. These are your holding companies that own and manage properties and collect rent and then pay you a dividend straight to your account. Think Zillow, CoStar, or Simon Property Group. Some ETFs for each of these sectors are called SPDR ETFs. We'll talk about them later. But go ahead and write them down right now. Let's take a deep dive on how the 11 sectors influence the price of the S&P 500. So each sector has a certain weighting, and because they have a certain weighting, each sector has an assigned price to it that equals the current price of the S&P 500. So if you look at all 11 sectors right here, they each have their own price. Technology weighs the most. If they have a good day or a bad day, the market will definitely feel it. So a basic breakdown of how the stock market works is total U.S. stock market, then you have the indexes, then you have sectors, then you have industries, and then you have companies and stocks. Again, finding the best performing companies within the best performing sectors allows for a diversified portfolio that you can always tweak for your liking. Right here is the S&P 500 current sector weightings percentage. So as you can see, technology weighs the most at about 26%. Then you have financials coming in at second at around 15%. You have healthcare at around 14%, and it goes on and on. So here's an even deeper look at the 11 stock market sectors. The main 4 columns we'll be looking at are the number of stocks, the market cap, the profit margin, and the 1-year returns of each of the 11 stock market sectors. So each sector has a certain number of companies in it. The sector with the most companies in it is healthcare, sitting at about 1,126 companies. So this basically means out of all the stocks on the New York Stock Exchange and the NASDAQ, almost 1,100 of them are healthcare companies. The sector with the least amount of companies in it are utilities, with only 107 stocks in it. Next, we have market cap, which again is the total amount of money invested into a sector or a company. The sector with the most amount of money in it is technology, with it having around $23 trillion in it. The U.S. stock market has about $55 trillion worth of money in it. This means that nearly half of the money invested into the stock market, investors chose to invest it in technology. The sector with the least amount of money in it is real estate, sitting at about $1.6 trillion. Now this may seem like it's still a lot, but when you think about the total amount of money in the world, which is around $80 trillion, the total amount of money invested in the U.S. stock market, $55 trillion, and then just $1.6 trillion in real estate, it lets you get a better understanding of what investors truly would rather invest in, which is technology. This is why the U.S. is so wealthy, because for the longest, we've led in innovation. Next, we have profit margin. Profit margin essentially means how much profit you keep for every $1 of total revenue you brought in. For example, NVIDIA, the largest company in the world, has a net profit margin of 50%. This means for every dollar they bring in, they keep 50 cents. So on a realistic level, this is the same thing as them bringing in $150 billion in revenue and keeping $75 billion to themselves, which is what they did last year. year. Then you take a company like Target, who has a profit margin of 4%. This means for every dollar they bring in, they keep 4 cents. Compare that to Nvidia and you see why Nvidia's stock price has shot to the moon and Target's has crashed and burned. The sector whose companies have the best profit margins are financials, sitting at almost 19%. Healthcare has the lowest profit margin, sitting at about 4.3%. Lastly, we have the 1-year returns for the 11 sectors. The sector that has returned the highest was communication services, sitting at 40%. This means if you put in $10,000 last year, you would have an extra $4,000 in your pocket for a total investment worth of $14,000. The sector that returned the least was energy, returning a negative 0.95% return. If you put in $10K a year ago, you would be down $95, and you now have $9,905. This is why it's important to invest in ETFs, because entire sectors can still give you amazing returns of 40%, similar to single stocks, but without all the risk. And it can protect your losses, as the energy sector had companies go down 40% or even more, but yet you will only be down 0.95%. Here was the breakdown of the stock market industries. Quick note, before we jump into the industries, when looking at market cap or big numbers, always pay attention to the letter that represents the dollar amount. For example, an industry that has a market cap of $868.54 billion breaks down as the following. $868.54 billion is the same thing as it being written like this with 7 zeros. So whenever you see a comma wherever they've abbreviated the market cap and it has a letter, it means it's the next power of 10. So if it's a billion, it's going to be a trillion. If that was an M and it had a comma, that would have meant it's a billion. So for an example, asset management has a market cap of 1.3 trillion. The comma means it's no longer in the billions. It's now in the trillions. So 1,323.68 billion breaks down just like this. The numbers after the decimal are in the trillions and billions. So that 1 is in a trillion, the 323 is in the billions. They are after the decimal. The number before the decimal is everything below a billion. So that's 680 million. As you can see right here, 680 million. I know that was kind of confusing, but the more y'all look at these numbers, the more y'all get it. Alright, so there are 145 different industries in the stock market. The sector with the most amount of companies in it are biotechnologies, sitting at 627 companies. The least is going to be infrastructure operations, with just 1 company in it. You can actually click on it and see the company that's inside. I ain't gonna lie, I ain't never heard of Beep, but let's keep it pushing. Alright, so we're going to hit this market cap button. We're going to search for the one with the highest market cap. The sector with the most amount of money in it is semiconductors with 8.5 trillion. Click on it and you will see the top companies in the industry. Look no further, we have Nvidia at number 1, Broadcom at number 2, Taiwan Semi at number 3. These are some of the best companies on the planet and all of the numbers reflected. Semiconductors are in every electronic device you own and it's arguably the most important industry. I own tens of thousands of dollars in semiconductor ETFs like SMH or SOXL. I long-term hold SMH and I swing trade SOXL since it's a leveraged ETF and it has crazy price swings. The industry with the least amount of money in it is again infrastructure operations with only $157 million in it. The industry with the highest profit margins are REITs at about 32%. REITs stand for Real Estate Investment Trusts and they are companies who own massive amounts of real estate all over the world. They are famous for paying out large and consistent dividends as they are legally required to distribute at least 90% of their taxable income to shareholders as dividends each year. You can look up and invest in REIT ETFs, which hold REIT companies, and you will get a fat dividend every couple months. The industry with the lowest profit margin is biotech, sitting at about negative 38%. This means for every dollar they make, they lose 38%. Biotech companies are known for being unprofitable, being massive amounts of debt, and to eventually go bankrupt. Biotech companies can make you extremely rich if you pick the right one, because they normally trade for pennies on a dollar and can skyrocket thousands of percentage points if they come up with a cure for something. Lastly is the 1-year returns. The industry that returned the most was advertising agencies, giving a 340% return. This is turning $10,000 into $44,000. Just use an investment calculator and plug in your starting amount followed by the return and it'll tell you your final balance. Keep in mind the S&P 500 returns an average of 10% per year. Now compare that to 340%. The industry that returned the least was chemicals, returning a negative 36%. This means you've lost more than a third of your total position. So as y'all can see, there are plenty of ways you can beat the S&P 500 by investing in sectors or industries that make the S&P 500 go higher. Because remember, all of these sectors are in the S&P 500. It's on the industry and company level where they can be entered or kicked out of the index. All 11 sectors are in the S&P 500, but not all industries and not all companies are in there. Remember, you have the total U.S. stock market, then you have the indexes, then you have sectors, industries, and companies or stocks. As you get further down the list, you'll get more specific and unique. Indexes were designed to go up forever. As you can see, since 1927, the U.S. stock market has been on a trajectory that is up and to the right, signaling strong growth as a country. The reason why indexes are poised to go up forever is because of the passive nature of the filtration system. Since terrible performing stocks can be kicked out of the index and be replaced by stronger and better companies, the index will always get higher and higher as long as companies keep growing. There are companies that were around in 1927 that are no longer here and went bankrupt, but the index still stands.